It's February 2026, and $300 billion just evaporated from the stock market in a single week. Not from some random crash, not from economic collapse, but from a single announcement by an AI company most people have never even heard of. Software giants that seemed untouchable are bleeding value at rates that would make seasoned traders sick to their stomachs. HubSpot down 39%. Figma crashed 40%. Even Salesforce, the behemoth that revolutionized cloud software, has lost a quarter of its value. And Wall Street? They're still telling you to buy. They're projecting double-digit returns. They're saying the AI boom is just getting started. But here's what they're not telling you. The very technology they're betting billions on might be about to devour the entire software industry whole. And if you're listening to the consensus right now, you might be walking straight into a financial massacre. Let me take you back to early February 2026. Anthropic, an AI company backed by Google, released something called Claude Cowork with 11 specialized plugins for legal work, sales, marketing, and financial analysis. Within 72 hours, Thomson Reuters plunged 16%. LegalZoom dropped more than 15%. The London Stock Exchange Group fell 13%. FactSet, Experian, and dozens of other companies that provide data and professional services watched their stock prices crater in what traders are now calling the SaaS-pocalypse. The WisdomTree Cloud Computing Fund collapsed 6.5% in just 1 week, capping a brutal 20% decline for the year. This wasn't a random sell-off. This was investors suddenly realizing that artificial intelligence isn't just a tool that makes software better. It might be the thing that makes traditional software obsolete. Now, before we go further, I need you to understand what's actually happening here, because Wall Street is painting a very different picture. According to more than 60 major financial institutions compiled by Bloomberg, optimism about AI stocks is almost universal. Fidelity International calls AI the defining theme for equity markets in 2026. BlackRock says the technology will likely keep trumping tariffs and traditional macro drivers. NatWest describes it as a powerful engine of economic expansion. Morgan Stanley projects the bull market continuing into a fourth year with near double-digit percentage returns for the S&P 500, targeting around 7,500. Goldman Sachs analysts estimate that major technology companies will invest $527 billion in AI capital expenditure in 2026 alone. Some reports suggest it could hit $700 billion. JP Morgan Wealth Management literally said the biggest risk is not having exposure to this transformational technology. Everything sounds incredible, right? The narrative is simple and seductive. AI is revolutionary. Companies are pouring unprecedented amounts of money into it. Therefore, AI stocks must go up. Wall Street's entire thesis rests on one fundamental assumption, that this massive spending will translate into even more massive profits down the line. But here's where the story gets interesting and terrifying. Let's talk about what's really happening with the money. The consensus estimate among Wall Street analysts for the hyperscaler group's 2026 capital spending is now $527 billion, up from $465 billion at the start of the third quarter earnings season. These companies spent $106 billion in capital expenditure in just the third quarter of 2025, representing a year-over-year growth rate of 75%. Morgan Stanley analysts estimate that big tech companies will spend about $3 trillion on AI infrastructure through 2028, with their own cash flows covering only half of that. $1.5 trillion will need to come from somewhere else. Debt. Lots and lots of debt. Goldman Sachs found that hyperscaler companies have taken on $121 billion in debt over the past year, a more than 300% increase from the industry's typical debt load. And here's where it gets truly wild. Much of this debt is being structured through special purpose vehicles to keep it off balance sheets. A tech firm makes an investment in a data center. Outside investors put up most of the cash. Then the special purpose vehicle borrows money to buy the chips that go inside the data centers. It's a shell game with hundreds of billions of dollars. But surely this massive investment must be generating returns, right? Well, let's look at the numbers. An MIT Media Lab report from August 2025 found that despite $30 to $40 billion in enterprise investment into generative AI, 95% of organizations are getting zero return. Zero. Alex Mason, an analyst who claims to have accurately predicted market movements in 2022, points out that the AI sector currently burns approximately $400 billion annually, while generating between $50 billion and $60 billion in revenue. That's an 8-to-1 spending to revenue ratio. For context, that would be like you spending $8,000 every month while only earning $1,000. How long could you sustain that? Major AI companies are reportedly losing tens of billions each year. OpenAI, valued at potentially $800 billion, is projected to run out of money by mid-2027, according to some estimates. Deutsche Bank analyst Jim Reed estimated OpenAI's losses could amount to $140 billion between 2024 and 2029. Former Fidelity manager George Noble said that OpenAI is burning $15 million per day on their video generation tool, Sora, alone. $15 million every single day on one product. And here's the really insidious part. Much of the revenue that AI companies are generating isn't even coming from outside the ecosystem. It's circular. NVIDIA invested in OpenAI. OpenAI uses that money to buy NVIDIA chips. Microsoft invests in OpenAI. OpenAI uses Microsoft's Azure cloud infrastructure and pays Microsoft for it. It's a closed loop where money keeps circulating within the same group of companies, creating the appearance of demand and revenue growth, without actual external customers paying for products at sustainable prices. The last time we saw circular financing and investment patterns like this at scale was during the dot-com bubble, and we all know how that ended. Now let's talk about what just happened with Anthropic and why it sent shockwaves through global markets. Claude Cowork isn't just another chatbot. It's what's called an agentic AI, meaning it doesn't just respond to questions, it actually takes actions. It can access your file system, manipulate documents, research information across the web, and execute complex multi-step business processes without human intervention. The legal plugin doesn't just draft a document. It triages non-disclosure agreements against a firm's internal playbook, flags non-compliant clauses, and independently researches case law to generate comprehensive litigation strategies. The sales plugin functions as a self-directed lead generation engine, pulling data from platforms like Salesforce, researching prospects across the live web, and drafting hyper-personalized outreach campaigns. This is fundamentally different from the Copilot tools of 2024 and 2025. Those were advanced autocomplete. This is operational AI that bypasses the software interface entirely. Think about what this means. A junior lawyer at a major firm typically bills clients for 10 hours of contract review work. Claude Cowork can do the same work in 10 seconds. A sales development representative might spend all day researching prospects and crafting outreach emails. Claude Cowork does it while you're getting coffee. The billable hour model, the seat-based subscription model, the entire pricing structure of professional services and software as a service companies, all of it is under existential threat. And Anthropic isn't stopping. They release these plugins as open source, meaning any company can customize them for their specific needs. Medical Cowork is rumored to be in beta testing with major hospital networks. On February 6th, just days after the plugin release triggered the software crash, Anthropic debuted Claude Opus 4.6, an even more advanced model with a 1 million token context window and the ability to coordinate whole teams of AI agents. Financial data providers got hammered. FactSet dropped 10%. S&P Global, Moody's, and NASDAQ all saw sharp declines. This wasn't isolated panic. This was the market suddenly repricing entire industries. The software sector response has been fascinating and desperate. Box CEO Aaron Levy, whose company's stock is down 17% in 2026, said, "This is the most exciting moment we've ever had in the company's 20-year history." Salesforce CEO Mark Benioff told Fortune his company won't be hiring any additional software engineers, customer service agents, or lawyers because of AI tools. Read that again. The CEO of one of the world's largest software companies just admitted AI can replace the very workers his company employs. JP Morgan analysts tried to calm fears, saying the sell-off had been indiscriminate and that a worst-case scenario remained unlikely. They argued that AI is more likely to be additive to software workflows in the near term rather than a substitute. But Goldman Sachs strategist Ben Snyder issued a chilling warning. He said this may be just the end of the beginning of a decline, not its end. Snyder drew parallels to newspapers and tobacco, industries where disruptive technology or regulation caused prolonged multi-year declines in stock prices. He noted that in those cases, share prices only stabilized after companies' earnings fell for years, and by the time profits recovered, most of the equity value was gone. Newspaper stocks declined by an average of 95% between 2002 and 2009. So we have two completely contradictory narratives happening simultaneously. On one side, Wall Street is projecting 7,500 for the S&P 500, calling for 14 to 16% annual earnings per share growth, and saying AI is the defining theme that will keep driving markets higher. On the other side, we have an entire sector down 30% in 3 months, circular financing patterns reminiscent of the dot-com bubble, spending that dwarfs revenue by 8 to 1, and new AI tools demonstrating they can actually replace the software products, generating hundreds of billions in annual revenue. Both of these things cannot be true. Either Wall Street is right, and this is a temporary panic over technology that will ultimately enhance rather than replace existing business models, or we're watching the early stages of a massive bubble pop combined with genuine technological disruption of trillion-dollar industries. Let's look at the valuation picture, because this is where things get truly concerning. The Buffett indicator, which measures total stock market capitalization relative to GDP, now sits at 223% of GDP. At the peak of the dot-com bubble, it was 150%. We are 50% higher than the most infamous bubble in modern market history. The cyclically adjusted price-to-earnings ratio for U.S. equities was about 37 as of November 2025, which is in the top 10% of valuations since 1988. The S&P 500 is trading at 23 times forward earnings, while the FTSE index trades at 14 times, showing just how expensive the U.S. market has become relative to the rest of the world. The concentration risk is staggering. The top 7 companies now comprise 53% of S&P 500 returns, 30% of the U.S. S&P 500, and 20% of the MSCI World Index is held up solely by the 5 largest companies. This is the greatest market concentration in half a century. When you have that much weight on so few companies, a problem with just 1 or 2 of them can trigger systemic instability, and we've already seen glimpses of this fragility. In early February 2026, there was a flash crash that affected stocks, gold, and silver simultaneously, demonstrating how interconnected and vulnerable the financial system has become. This wasn't a normal correction where stock prices fall, but safe havens hold up. Everything crashed together. The February flash crash exposed what analysts are calling extreme valuation metrics. When the AI spending story wobbled even slightly, it cascaded across all asset classes. Market analyst Mark Chaikin, a Wall Street veteran, assigns a 65% probability to a bear market in 2026, with average losses of 20%, with stocks likely bottoming in fall 2026. His analysis points to historical 4-year market cycles that have played out consistently over a century of data. Multiple economic headwinds are converging. Unemployment has climbed from 4.0% to 4.4%. Monthly job growth has slowed to just 50,000. Consumer anxiety about job security has hit 20-year highs. And inflation, which everyone thought was conquered, is showing signs of coming back. Some prominent Wall Street banks are expecting inflation to tick up in 2026, which could push the Fed to raise rates or, at minimum, stop cutting them, making borrowing costs higher right when companies need to refinance all that AI infrastructure debt. Now let's talk about what Wall Street is specifically getting wrong. Their entire thesis rests on the assumption that AI spending will translate to AI profits on a timeline that justifies current valuations. Analysts are projecting 14 to 16% annual earnings per share growth in 2026. For the 493 stocks in the S&P 500 other than the Magnificent 7 mega-cap tech companies, this would represent a doubling in the pace of earnings growth compared to 2025. That is an extraordinarily high bar. It assumes that all this capital expenditure starts generating returns immediately. But history tells us technology infrastructure build-outs take years to monetize. During the telecom boom of the late 1990s, companies spent hundreds of billions laying fiber optic cable. The infrastructure was built for a future that hadn't arrived yet. When demand didn't materialize on the expected timeline, the debt became worthless and we had a financial crisis. We're seeing eerily similar patterns now. AI CapEx has recently equated to 0.8% of GDP. To match the peak of the late 1990s telecom cycle, AI hyperscaler CapEx would need to reach $700 billion in 2026, which some reports suggest might actually happen. The second thing Wall Street is getting wrong is underestimating the speed of disruption. Traditional analyst models assume technology adoption follows predictable S-curves over years or decades, but we just watched an AI tool announcement wipe 30% off an entire sector's value in weeks. The pace of change is exponential, not linear. When GPT-4 launched, it could pass the bar exam. Now, Claude Cowork can actually practice law by performing the tedious iterative work that constitutes the bulk of a junior lawyer's day. That's not incremental improvement. That's a phase change. Goldman Sachs' chief equity strategist argues that the rapid appreciation in stock prices is substantiated by robust profit growth. But what happens when those profits are at risk because AI is replacing the products generating them? Microsoft reported a 60% year-over-year jump in profits, but the stock still fell 10% because analysts thought 39% cloud growth was too low. Amazon got punished with an 8% drop for missing earnings estimates by 2 cents per share. The market is already hypersensitive. Any sign that AI spending isn't translating to revenue growth triggers selling. That's not bubble behavior in the sense of irrational exuberance. That's bubble behavior in the sense of maximum fragility. The third thing Wall Street is missing is the monetization problem. Yes, companies are spending unprecedented amounts on AI infrastructure, but how do they make money from it? Anthropic is giving away plugins as open source. OpenAI is losing billions. The business models aren't there yet. And here's the critical thing everyone's ignoring. AI's entire value proposition is that it makes things cheaper and more efficient. It reduces costs. It eliminates jobs. It collapses pricing. That's deflationary, not inflationary for corporate profits. When Anthropic can do in 10 seconds what a lawyer bills 10 hours for, where does pricing settle? It doesn't settle at 9 hours of billing. It settles at something dramatically lower because the cost structure has fundamentally changed. This is why software companies are terrified. Their pricing power evaporates the moment a general-purpose AI can do what their specialized software does. Fourth, Wall Street is completely underestimating the disruption to software. The iShares Expanded Tech Software Sector ETF is down 30% since late October. That's not a correction. That's a repricing of future cash flows. Deutsche Bank strategist Jim Reed said recent months have seen a clear shift from AI euphoria toward more differentiation between companies and growing concern about disruption to existing business models. JP Morgan analyst Toby Ogg said the software sector isn't just guilty until proven innocent, it's now being sentenced before trial. General appetite to step in remains low, citing risks including competition from AI-native firms and clients building their own solutions in-house. That last part is critical. Why would a company pay Salesforce millions for CRM software when they could have Claude customize an AI agent to do the same thing? The moat around software businesses, the thing that justified their valuations, is evaporating in real time. Let me give you specific examples of what we're talking about. Salesforce stock is down 26% in 2026, making it the second worst performing stock in the Dow Jones Industrial Average. This is a company that was considered one of the most dominant, unassailable players in cloud software. HubSpot has cratered 39% year to date after sliding 42% in 2025. That's a 67% total decline from peak to trough. Figma down 40%. Atlassian down 35%. Shopify down 29%. ServiceNow, Workday, SAP, all getting hammered. These aren't startups. These are mature, profitable companies with massive customer bases and recurring revenue. The market is telling us it believes their terminal values are at risk. And here's the scary part. The market might be right. Anthropic CEO Dario Amodei has warned that AI will cause unusually painful disruption to jobs, arguing AI could displace half of all entry-level white-collar jobs in the next 1 to 5 years. When the CEO of an AI company is warning about painful disruption, you should probably listen. Now, let's talk about what some smart people are saying that contradicts the Wall Street consensus. Economist Dean Baker warned of a stock bubble in the late 1990s and reduced his market exposure. He was right. He then warned about soaring home values in the mid-2000s and sold his condo. He was right again. Baker sees warning signs now in AI spending that mirror both previous bubbles. The Bank of England warned of growing risks of a global market correction due to possible overvaluation of AI firms. They said valuations could be harmed if infrastructure requirements for sustaining the technology are too high to be met. They added that investors are not properly cautioned about the risks of a stock market crash if AI falls short of market expectations. The International Monetary Fund agreed and reinforced the Bank of England's claims. IMF Managing Director Kristalina Georgieva drew comparisons to the dot-com bubble, highlighting that a market correction could stunt global growth and weaken economies of developing countries. Jamie Dimon, head of JP Morgan, said in October that he thinks AI is real but believes some money invested now will be wasted. He said there's a higher chance of a meaningful drop in stocks over the next 2 years than the market is reflecting. Dimon warned that an AI-driven stock crash could result in a lot of money being lost, though he acknowledged AI will eventually pay off just like cars and TVs did, even though most people involved in those industries didn't do well. Vanguard's economic and market outlook for 2026 struck a notably cautious tone. They're bullish on bonds, but less so on U.S. stocks. They point out that for U.S. equities, the KP ratio was about 37, which is in the top 10% of valuations since 1988. They also note that as capital-intensive AI projects proliferate, the potential rises for credit stress, especially among lower-rated issuers. In late January 2025, the launch of DeepSeek, a Chinese chatbot that achieved impressive results with a fraction of the compute resources American companies were using, triggered concerns about an AI bubble. NVIDIA's shares dropped 17% in one day, though they recovered 8.8% the next day. But that volatility is a warning sign. When a single product announcement can move hundreds of billions in market cap, you're not in a stable, fundamentally driven market. You're in a sentiment-driven, fragile market. Art Hogan, chief market strategist at B. Riley Wealth Management, said if things are advancing as rapidly as we hear from OpenAI and Anthropic, it's going to be a problem. Investors are starting to go after any companies that could be disrupted, which is all kinds of software application names. The question isn't whether AI is transformative. It clearly is. The question is whether current valuations reflect realistic timelines for profitability, and whether the companies everyone's betting on are the ones that will actually capture the value. Stephen Yu, chief investment officer at Blue Whale Growth Fund, told CNBC that the AI market is tipped to splinter in 2026. So far, every company seems to be winning, but AI is in its early innings. It's very important to differentiate between companies with a product but no business model, those burning cash to fund AI infrastructure, and those on the receiving end of AI spending. The market hasn't made those distinctions yet. When it does, there will be clear winners and losers, and a lot of current high flyers will be in the loser category. Here's what's really happening and what Wall Street doesn't want to admit. We're in a period of maximum confusion and maximum risk. The technology is advancing faster than anyone expected. The capital being deployed is unprecedented. The potential for disruption is enormous. But the business models are unclear, the path to profitability is murky, and the valuations assume everything goes perfectly on an aggressive timeline. When you combine massive debt loads, circular financing, extreme valuations, market concentration, and rapid technological disruption, you don't have a recipe for sustained bull market. You have a recipe for violent repricing when reality fails to meet expectations. And we're already seeing the first cracks. The software sector crash isn't a one-time event. It's the beginning of a fundamental reevaluation of which companies have durable competitive advantages in an AI-native world. So what does this mean for you? If you're listening to Wall Street's consensus view that AI stocks are the place to be, that 7,500 on the S&P is coming, that this bull market has years to run, I want you to understand what you're betting on. You're betting that $527 billion in capital expenditure this year translates to proportional revenue growth. You're betting that AI enhances rather than replaces existing software. You're betting that current valuations are justified by future earnings that double from last year's pace. You're betting that circular financing patterns are sustainable. You're betting that debt loads 3 times historical norms are manageable. You're betting that market concentration at 50-year highs isn't a fragility risk. You're betting that inflation stays low, unemployment doesn't rise further, and the Fed keeps cutting rates. That's a lot of things that all have to go right simultaneously. Meanwhile, the counter-narrative is based on observable facts. AI companies are burning 8 times more than they're generating in revenue. 95% of enterprises implementing AI are getting zero return. A single product announcement wiped $300 billion off market value in days. The Buffett indicator is 50% higher than at the dot-com peak. Unemployment is rising. Debt loads are exploding, and the technology itself is demonstrating it can replace entire categories of software and professional services. Which narrative sounds more risky to you? Here's my assessment. Wall Street isn't necessarily wrong that AI is transformational. They're wrong about the timeline, the path to monetization, and which companies will capture the value. They're wrong about the sustainability of current spending levels. They're wrong about the resilience of incumbent software companies. And they're spectacularly wrong about valuations that price in perfection when we're in the most uncertain, volatile period of technological transition in decades. The smart money isn't following the Wall Street consensus. The smart money is being extremely selective, focusing on companies with actual positive cash flow from AI, avoiding the highest flyers, maintaining significant cash positions, and preparing for the possibility that this doesn't end well. Does that mean you should sell everything and hide in cash? Not necessarily, but it means you should be acutely aware that Wall Street's bullish projections are based on assumptions that may not play out. It means position sizing matters more than ever. It means having realistic exit strategies if the narrative shifts. It means understanding that when everyone from Fidelity to BlackRock to Morgan Stanley is telling you the same story about AI being the defining theme, you need to ask yourself what they're missing. And right now, what they're missing is the very real possibility that we're in the early stages of both a bubble pop and genuine disruption that destroys value for many of the companies they're recommending. The February 2026 software crash isn't the end, it's the beginning. Over the next year, we're going to see more of these repricing events as the market gradually figures out which business models survive AI disruption and which don't. We're going to see more debt come due that needs to be refinanced at higher rates. We're going to see more companies missing earnings expectations because AI spending didn't translate to revenue on expected timelines. We're going to see more circular financing unwind when outside capital stops flowing in. And when those things happen, the Wall Street analysts who are projecting 7,500 on the S&P are going to be scrambling to downgrade their targets and explain what went wrong. The really dangerous part is that by the time the consensus shifts, retail investors following Wall Street's advice will have already taken significant losses. That's how it always works. The professionals will rotate out first. The institutional investors, who have better information and faster reflexes, will move. And everyone listening to CNBC saying AI is the defining theme of 2026 will be left holding positions that are down 30, 40, 50%, wondering how this happened when everyone said it was the opportunity of a lifetime. This isn't about being pessimistic. This is about being realistic. Extraordinary claims require extraordinary evidence. Wall Street is making extraordinary claims about AI stock performance with projections that assume everything goes right. But the evidence suggests we're in one of the most overvalued, overleveraged, fragile market environments in decades. The evidence suggests AI is disrupting faster than anticipated. The evidence suggests business models are unclear and paths to profitability are uncertain. The evidence suggests we're in the early stages of a major repricing event, not the beginning of another multi-year bull run. So yes, it's over. Not in the sense that AI as technology is over. AI will continue advancing and will transform the economy. But it's over for the naive belief that simply buying AI stocks and holding them is a winning strategy. It's over for the idea that Wall Street's consensus view is based on solid fundamental analysis rather than momentum and hope. It's over for software companies that can't articulate how they survive when AI agents can do what their products do for a fraction of the cost. It's over for the valuations that assume perfect execution on aggressive timelines. It's over for investors who think they can ignore warning signs because everyone credible is saying the same thing. The SaaS apocalypse is real, the circular financing is real, the debt loads are real, the valuation extremes are real, the disruption is real. And Wall Street telling you everything is fine, while evidence to the contrary piles up daily, is perhaps the biggest red flag of all. In late 1999, every major financial institution was bullish on tech stocks. In early 2007, Wall Street was unanimous that housing was sound. In early 2026, every major firm says AI is the defining theme and you need exposure. History doesn't repeat, but it often rhymes. And right now it's rhyming loudly. The choice is yours. You can follow the consensus and hope they're right, despite mounting evidence they're missing something big. Or you can think independently, question the narrative, and position yourself for a market environment that's far more dangerous than Wall Street is letting on. Because when software CEOs are admitting they won't hire workers because AI can replace them, when trillion-dollar sectors are crashing 30% in months, when debt loads are 3 times normal and spending is 8 times revenue, that's not the time to be aggressive following consensus recommendations. That's the time to be defensive, selective, and brutally honest about the risks you're taking. Wall Street is wrong about AI stocks in 2026. Not wrong that AI is important. Wrong about the timeline, the winners, the valuations, and the risks. And by the time they admit it, it'll be too late for everyone who listened.